On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Right, good morning, all. Been a week or two since I've recorded one of these. I hope you've all enjoyed your school holidays as much as I have. Those of you that have young children, back to it on Monday. Work starts again for me. The kids go back to school. Number three actually having his first day at school, so that's a bit of a milestone for us. So I thought I would jump on here and try and get back into the swing of markets as well. It has been a bit of a difficult period over the last couple of weeks, and we've seen the volatility across financial markets continue, largely driven by what we've seen in terms of bond yields and interest rates. So we'll talk about that. But just starting with share markets last week, it was a pretty difficult one in most parts of the world. The US, which has actually had a fairly tough time of late, managed to rebound. So we saw the S&P 500 rise 0.5%, but it's still about 6% off its highs. The highs which came in the end of July, so it's still down over the last couple of months. Other markets were mostly lower last week. We had the UK down 1.5%, Europe off 1.2%. Aussie off 1.3%. The local market was pretty much flat, but the nervousness has continued out there, and most markets are off the boil a little bit from their recent highs. Like I said, the US market off 6.1% from its peak from late July. Aussie's down about 6.7, New Zealand down about 6.4. That. So we've seen a little bit of weakness and a bit of volatility creep in. Many markets are still up quite solidly year to date. The S&P 500 in the US still up more than 12% this year. The UK is flat or up a few percent if you include dividends. The Aussie market is down about 1%, but again, it'd be up if you added dividends back in. The New Zealand share market still lagging a little bit. We're down 1.6% year to date, so we have had a bit of a softer year compared to many others. Interest rates have been the culprit. We've seen bond yields rising everywhere. In the US, this has got a lot of attention and a lot of press coverage. Last week, we saw the US 10-year Treasury yield, so that's a government bond yield, the 10-year rise to 4.9%. That's the highest we've seen since July 2007. And back then, in the lead up to the GFC, it was a little bit earlier in 07, I think it was around May or June, that 10-year Treasury yield pushed as high as 5.3%. So whether we push through towards those levels, your guess is as good as mine, but we are at the highest that we've seen in about 16 years. In the UK, it was a similar story, or everywhere really, but in the UK, we had the 30-year gilt. That's what they call their government bonds. The 30-year gilt closed above 5% for the first time since 2002. Which sees it higher than it went last September. Some of you will remember that mini budget disaster that they had. That was during the very brief prime ministership of Liz Truss. I think that lasted 49 days from memory. But during that period, they released a mini budget, which was taken really badly by the market. And the market just saw risk and uncertainty, and they didn't like any of that. And you saw interest rates rise in the wake of that release. So now we've actually gone above those levels, which means we're at the highest since the early 2000s. Similar story here in New Zealand. We saw our 5-year swap rate finish the week at 5.35%, which is the highest we've seen since 2010. So not you don't have to go as far back as you do in the US or the UK to find a time when it was that high, but still 13 odd years. So, bond yields everywhere have pushed higher. And a lot of that, interestingly, has been due to higher growth expectations, more so than higher inflation. There's sort of three key components of what makes up bond yields. You've got the growth component, the inflation component, and then you've got what we call the term premium, which is what you get paid for, lending your money sort of for longer out into the future. And it's not the inflation piece that has pushed bond yields higher. In fact, most inflation readings that have come out lately, we saw it with the PCE inflation in the US last time we got that. We saw it with German inflation, actually been a little softer than expected. So it hasn't been higher inflation, but I think it has been expectations of higher growth and probably people rethinking where the neutral rate is, which is the steady state level of interest rates where you're not stimulating the economy, but you're also not trying to put the brakes on. And that neutral rate in the eyes of many market participants is actually higher than we've thought. So that could be a factor. You've also had central banks working quite hard to push the message of higher for longer. So even though we haven't seen the likes of the Federal Reserve, the Reserve Bank of New Zealand, the Reserve Bank of Australia raise interest rates, they have used their messaging to get the market thinking about interest rates remaining at a higher level, plateauing, but then staying high instead of markets getting too excited about interest rate cuts anytime soon. Higher oil prices have probably been a factor. We've had the prospect of more issuance because you've got governments that are running higher debt levels these days. You've got expectations of the Bank of Japan moving to a less stimulative stance. That could be a factor as well. So I think all of those things together have conspired to push those interest rates a little bit higher. No need to really panic, I don't think. It does sound quite scary what you see in the headlines, but it's really only the bonds with extremely long maturities that have been suffering heavily. So as an example, in the US, there's an ETF that tracks treasury bonds with a maturity of 20 plus years, and it's had a tough year. It's down 15 or 16%, and that's because higher interest rates impact those longer duration assets more. So those bonds that have got 10, 20, 30 years to run, they will be much more impacted by changes in interest rates than bonds that have got 2, 3, 5, 7 years to run. So when you look at some of those bond indices, even in places like the US where the moves have been very significant, those bond indices or those ETFs or other securities that follow or own bonds of a much shorter time frame, they haven't fallen nearly as much. And in New Zealand, our corporate bond index and bonds in this part of the world don't tend to be sort of, out 10 years, 20 years, 30 years. Most private investors, the corporate bonds that they're buying might be in that, 5 to 7 year range when they're issued. That corporate bond index here is actually up this year. It's actually up 2.1%. So it's still performed very well. That's in fact a better performance than we've seen from the NZX 50, which is down slightly, or the likes of the Dow Jones Industrial Average, which hasn't benefited like the S&P 500 or the Nasdaq because it doesn't have all the tech stocks. So it's not all bad out there. Don't panic from what you're seeing and hearing. The bonds that we tend to invest in this part of the world haven't been nearly as impacted by some of those bond yield movements that you've seen overseas. And another point I think we should make is that if you're a conservative investor looking to lock in some attractive income over the next few years, this is actually a great opportunity. When you've got interest rates that are at the highest levels we've seen in 10 or 15 years, that is a great environment for people that have money to put to work in conservative fixed income investments. So it's a great chance to lock in some of that income, a great opportunity to take some money out of those short-term deposits and lock it up for a longer period at rates that are north of 6% in many cases. So certainly not all bad, but it has created a difficult environment for other asset classes like shares. Right, looking back at last week's data and other releases. Here, the big one was the RBNZ, the Reserve Bank. So with no change to the OCR, it's still 5.5%. The highest we've seen since that sort of 07, 08 period. And in 08, I should say, in 07, it sort of went higher than that. Back in those days, the OCR did peak at 8.25. So we're still not back at those pre-GFC levels, but the highest in many years still. Everyone expected it to stay the same, so no one was picking a change. So in that sense, it was in line with expectations, and the Reserve Bank did hedge its bets about it, what it might do from here. The jury's still out as to whether we see another rate hike. Markets are pricing in some chance of another hike. About a 40% chance of a hike is priced in for that final meeting of the year, which will come in November. And I know a couple of the bank economists, the likes of ANZ and Westpac, have still got another hike formally in their numbers. So plenty of smart people out there believe that the Reserve Bank isn't done. I'm not so sure. I think that there is a case for them just standing pat. So we'll wait and see. It might depend on the economic data. Next week, we've got the CPI release, the Consumer Price Index. I think that's next Tuesday, the 17th. So that will be an important one, probably the next big one ahead of that meeting in late November. Inflation here in New Zealand running at 6%. So that's down from the peak this cycle, which was 7.3, but 6% still way too high. The Reserve Bank has got it coming out at 6% again for the September quarter when we get those numbers next week. So we'll just wait and see, and we'll be watching, obviously, the sort of core elements to that inflation report. That won't be the only thing that comes out between now and when the Reserve Bank next meets. We'll also get some more unemployment figures. We'll get more business confidence readings, a few more dairy auctions, and some clarity on the election outcome as well. So still lots of water to go under the bridge. And I think something else we need to consider is that those increases we've seen over the last 18 months are still working their way through the economy. You've got mortgage rates that are around that 7% mark for the sort of 1 year, 2 year, 3 year, give or take 7%. But the actual fixed rate, the average fixed rate that people are paying is still in the very low fives. I think it's sort of circa 5.2%. So the reason for that big gap is because you've still got a large group of people that haven't come off the old fixed rate and moved on to the new one, which means that even if the Reserve Bank doesn't do any more, even if they just sit tight from here, you're still going to get that catch-up effect of actual people out there, borrowers and homeowners and people with mortgages, that will face those higher borrowing costs because they simply haven't sort of moved on to the higher rate. So there's still a bit of work that those previous increases in the OCR will do for the Reserve Bank. So that's why I can sort of see a case for them just sitting tight and waiting for that to play out. We had another dairy auction, and this was good. Third rise in a row. I think it was about 4%, 4.5%. We've seen a rebound in dairy prices globally of about 12% since mid-August when they hit a 5-year low. So we're still off about 10% year to date in terms of where prices have moved, but very good to see a bit of stability emerge. And a lot of that, I think, will have come from improved confidence and a bit more stability in the Chinese economy as well. So that was good news. Elsewhere last week, we had some economic data points come out of the US. We had the ISM indices, the Institute for Supply Management. So you get a manufacturing one, you get a services one. Both were pretty good. The manufacturing ISM index rose to 49. That's still below break even. Break even's about 50. Precisely 50 actually. So still below break even, but it's the highest since November last year. So that was good. That was a bit better than expectations. The services ISM was solid, 53.6, so easily in expansionary territory, well above 50, and also above the 6-month average. So that was another piece of good economic news, and it sort of ties into that rhetoric that we've seen in terms of bond yields responding to better economic data, more resilient economies. And obviously that's good. But the other side of that coin is that it means central banks might have to sort of keep the pressure on for a little bit longer. Similar story with the September jobs report, although there were a few elements that were still pointing to signs of easing. Generally, it was very good though. Headline payrolls were strong at 336,000, so that's the number of new jobs created in September, way above forecast for 170, the highest in 8 months. So the last time we had anything like that was back in January. So that's impressive. Unemployment stayed at 3.8%, still very low, but people were expecting that to fall to 3.7. So, that is probably an element of the report that falls into that signs of easing camp, as did the wage growth. The wage growth was a little bit softer as well. Average hourly earnings rose 0.2%, which was below forecasts. On an annual basis, it's tracking at 4.2%, also below expectations, and the lowest since June 2021, so the lowest in 2 years. And if we take the last 3 months and just take an average of those last 3 months and then annualize it, you've got wage growth running at about 3.2%. So we're actually not far off the levels where the Federal Reserve believes wage growth is consistent with their inflation target, which is about the 3% level. So that was positive. Generally a very strong jobs report, but some positives that we can take from it in terms of where the labour market is going and what it means for the inflationary outlook. The Fed's got 2 more meetings this year. So they've got one at the end of this month, end of October, in about 3.5 weeks, and then one in mid-December, the 12th and 13th, I believe. And markets are still 50-50 about whether we have another rate hike at one of those meetings. If we do, it would be seen as the last one for this cycle, and then there'd be on hold, higher for longer, but still on hold. Again, I'm not so sure. Like the Reserve Bank here, I think they've done a lot of work. They've increased interest rates from very low levels to something that looks more restrictive. So, we'll just have to wait and see. We'll just have to watch that data and see how it comes out. Which brings me to this week, and there's plenty going on this week. I won't talk about everything, but some of the key things that I'll be watching. One of them will be the US CPI. This will be the key global economic release. This will cover the month of September, out on Thursday night, so out for us in the early hours of Friday morning. Headline inflation in the US expected to come in at 0.3% for September. That'd be down from 0.6% in August. That'd be good. Core inflation expected to be in line with August at 0.3%. So when you look at that on an annual basis, that would see headline inflation slowing to 3.6, down from 3.7, lower since March 2021, so 2.5 years ago. And the core inflation at an annual level would come down to 4.1, which is the lowest since September 2021, 2 years ago. So, good news expected on the inflation front. Inflation's still higher than the Fed would like, but coming down as expected. So that will be something that will get a lot of attention overnight on Thursday. It's also the start of the quarterly reporting season in the US. Wouldn't you hate to be an equity analyst covering global equities every 3 months? You've got to cover these results. Be much easier to cover New Zealand or Australia, where they only report every 6 months. I do feel sorry for the international analysts out there, because those reporting seasons seem to come around so quickly. One finishes and then another one's starting. But, it's great for us market watchers. It gives us a lot to monitor and lots to follow. So the third quarter reporting season will kick off this week in the US. So this will cover the 3 months ending September. We've got PepsiCo on Tuesday. We've got Walgreen Boots Alliance and Domino's Pizza on Thursday. United Health on Friday. And some of the financial heavyweights: Wells Fargo, Citigroup, JP Morgan, BlackRock, all Friday. So lots going on, particularly in that financial sector. And that's a sector that will really be in focus given what we've seen in terms of bond yields rising. Investors will be wondering, what does that mean for capital levels? What's happening with deposits? Costs will be in focus, bad debts, what's happening with mortgage volumes, all of those things. Overall, markets are expecting earnings for the S&P 500 index in aggregate in the US Markets are expecting earnings to be pretty much flat on the same quarter last year. So when you take the September 2023 quarter, compare it to September 2022, no change. Actually, marginally negative, but it's very marginal. It's about 0.5% down. That'll be the fourth quarter in a row of earnings being down, and it's expected to be the last. Analysts are expecting a pickup and a return to sort of earnings growth, positive increases from the upcoming quarter, the December quarter. So because of that, I think outlook statements will be key. Traditionally, the earnings season can often be quite a positive catalyst for the market. So I guess when you think about where we're at the moment, with a lot of nervousness out there, and with the overall market in the US being down sort of 6 or 7%, the earnings season is one potential catalyst that could sort of turn that sentiment a little bit more positive, but that'll only happen if you actually get some good results. So this week it all starts. Most of those big results come late in the week, and then next week, the following week, you'll have tons and tons of releases to follow. So earnings season will very much be in focus overseas as well, particularly in the US. That's not all. There's plenty of other stuff going on. We've got the US PPI, the Producer Price Index, coming out a day before the CPI, the Consumer Price Index. So that CPI I talked about earlier, that's out overnight on Thursday. But overnight on Wednesday, you'll get the PPI if you want to follow that. We'll get the minutes from the last Fed meeting and the last ECB meeting, the European Central Bank. So we'll be able to learn more about why they did what they did and what they think. The latest IMF economic outlook is due. The International Monetary Fund will release that on Tuesday. We've got monthly GDP figures in the UK out on Thursday. We've got inflation data and trade data out in China on Friday. So plenty coming, but for me, it'll be that US CPI report and some of those results that I'll be watching most closely. In New Zealand, we've obviously got the election on Saturday, and this will be the key event. Only get them every 3 years. They're pretty exciting, and they do shape the policy backdrop for the next little while. So a very important event. We'll have a couple of polls to come. We'll have one final leaders debate, I think, on Thursday night on TV1, one apiece so far as I'm concerned. So, think of this one as a decider. In terms of the outcome and what it means after Saturday, look, I'll be honest. I think Winston's going to be there. In the last 7 polls, New Zealand First have averaged 5.7%, and in every single one of those 7 polls, New Zealand First have been above 5%. They usually go better on the night than they do in the polls. I think there are people who maybe don't want to admit to a pollster on the phone that they're voting that way, but in the privacy of their own polling booth, they might tick that box. So my guess would be Winston Peters will be in the mix. He'll be back, and that will mean that if you do get a national-led government, they will need his support, and that's still the way it's headed. My guess would be National Act New Zealand First. No guarantees that he won't go in the other direction. You never know. Although it looks much less likely than last time around. If you take the polls from the last month, National's averaging 37%, Labour's averaging 27%, the Greens are averaging 12%, Act 10%, Te Pāti Māori 2.3%, and New Zealand First 6, or just below 6, as I said. So you've still got that historically low level of polling for the two major parties combined. It's sitting around the 65% level, maybe a little below that, and it's usually, or at least often, it's sort of 70 or even 80%. So the smaller parties are still certainly doing well. The right bloc is definitely in the box seat. They will end up with more than the left, probably by a margin of about 5%. So if you add National and Act together, compare it to Labour, Green, Te Pāti Māori, the National and Act will probably have about more about 5% more on a combined basis. That's just my guess. I'm not an expert, but that's my guess. I don't think that'll be quite enough to get them over the line without New Zealand First. So that's what I'm expecting. Obviously, Winston Peters and New Zealand First have twice before been kingmaker, once in 96, once in 2017. So in 96, they went with Jim Bolger's National Party. In 2017, they went obviously with Jacinda Ardern and the Labour Party. They took 2 months to decide the first time, 1 month to decide the second time. So, we should prepare for maybe a bit of negotiating time if it plays out that way. Will it be the disaster that some out there in the media are suggesting? I don't think so. I think you hear a lot of hot air from all political parties on the campaign trail, but once it's done and dusted, they've got to work together. They've got to do their best, and I think love them or hate them, many of them do want the best for the country. So I'm sort of glass half full about how it might play out. Also conscious that we've had a majority government for the last 3 years, and we've still seen plenty of dysfunction and plenty of things not go according to plan. So it's not just minority governments with lots of moving parts that can get things wrong. Sometimes a very clean government with just one party in there with a very strong majority can still drop the ball plenty of times. So we'll wait and see. But we've written about the election a few times in the last few months, and I've recorded a couple of podcast episodes on it, so go back and take a look. We did one about how markets react in the aftermath, in terms of the share market, in terms of interest rates, in terms of the currency. So I won't repeat myself, but go and have a listen to that. But this will be the key event for us. So it's on Saturday. We'll have a clear picture of where things are at on Saturday night, certainly Sunday, and if things do emerge as I'm expecting them to, it might take a little bit longer than that for us to get complete clarity about what the makeup of the next government will look like, or something completely different could happen. Who knows? What do I know? That's just my guess about what might play out, but we'll wait and see. Definitely get your popcorn, get your beverage of choice, and sit back and enjoy the entertainment. It is an enjoyable sort of watch election night. Well, I find it enjoyable. The NRL season's finished, so I've got nothing else to watch on the weekends now. In terms of corporate events in New Zealand and Australia, at least, there's a few things, a few AGMs. We're not in a reporting season, but we have got some AGMs. Gentrack, Meridian Energy, Genesis here in NZ, and across the Tasman, a few big names as well: Commonwealth Bank, CSL, and Brambles, plus a few smaller companies too. So, yep, there's lots going on. Welcome back to work or markets, those of you that have enjoyed a school holiday break like myself, and we will get back into it and talk again very, very soon. Thanks for listening.